Hey, hello everyone, I am Chris with Elliott Wave Cafe. Welcome to today's video. This is for YouTube and I will discuss today how to buy a stock or whatever other instrument you're thinking of after an ABC correction. Now, we're taking a look at Schwab. SCHW is the ticker, and this is a weekly time frame. So we know, the stock market has been going through corrections between, most of 2022, and you can see that clearly in the chart. This is a weekly time frame with, just kind of simple bar, high, low, open, close chart. And if you're familiar with the Elliott wave structures, we have corrective patterns. So, I want you to focus on this move from this high back here in, the winter or early, I should say, 2022, all the way up here until early 2023. And this is the move that I'm interested in, right? So you see something like this on the chart, you might see it on smaller time frames too, and you're thinking, well, this looks like a corrective move against an ongoing trend. How do I buy this? How do I get involved into this? Because I want to participate in the next larger swing move to the upside, right? So you might look at this and say, well, I see 5 waves. Oh my goodness, let's get ready to buy. And this move could fail and it could roll over, right? So there is all kind of things that can happen when you have quite a big damage on a stock structure after a pretty interesting advance here, a pretty strong advance. So there's a couple of things. First of all, let's take a look at and I want you to maybe stop the video if you want and just try to count this move, from here to the top and see, what you come up with. And then, I think this one here is pretty basic, but you can go ahead and kind of try that as well. And then we'll go over and I'll show you kind of some of the ways that we're buying this. In terms of, by using Elliott Wave, but with few additional tools as well. So here is my count. I'm going to go to the next one over. And you can see, I'm labeling this as a wave 1, then as a big flat in a wave 2, in an A, sharp B, and then a drop in C for a wave 2. And then we go in this larger third wave. 1, 2, 3, 4, and 5. This looks like a diagonal in the wave 3. Then we come back in a 4, and then we go again in a 1, 2, 3, 4, and then a small fifth wave that finishes off. And then inside this third wave we have 1, 2, and then you have 1, 2, 3, 4, and 5. With another move inside here, right? 1, 2, 3, 4, and 5. I'm sorry, 1, 2, 3, 4 right there and 5. So I don't have the smaller degrees, but it's pretty obvious kind of what that is. Now from the top, we have your 1, 2, 3, 4, 5. So for a wave A, then you go up, and this A should be a little bit closer this way, and then you go up in another ABC move up here, and then you drop down in 5 waves. You have 1, 2, 3, some kind of a triangle in a fourth wave right there, and then you sharp drop in wave 5 of C with a truncated wave 5, right? Because this was such a sharp drop, usually the market, it doesn't have enough strength to overtake this low, which creates a truncation, right? Because most of the move was made into that pretty heavy decline up there from $80 to about 40. The stock got cut in half. So what do you do after you see such a structure? Let's say that you're patient, you've been watching this, you've been waiting for this to unfold, and you see these 5 waves, and then you say, oh my goodness, let's get going. That's where the tricky part comes in, right? Because you never really want to buy something that's going down. Just because you see these 5 waves, right, doesn't necessarily mean that that's what's going to be. I mean, the stock could just kind of hover around here for a little bit more, and all of a sudden you're making another low and another low and another low. So if you haven't seen that, I think every Elliott wave trader has been put to that test, right, of hey, I'm seeing 5 waves, what's going on in here. So rushing to buy, right as these moves are unfolding in here, it's a little bit risky. It doesn't mean that it could not work, of course, but you have to be very tight with your stops, and it's for those that maybe have a little bit of higher risk tolerance, right? Because I would use, obviously, once you see this low being made, right, you use that as a stop, and then if you make a new low, then then that's it, and you have to reinitiate at some point, if the structure starts to look fairly decent. But here is how I'm thinking about it. This is kind of how it works. So we're gonna go back and to the next chart right here, and you can see I have as a buy sign right here at the top of this B wave. I know this is a weekly chart, right? So you're saying, well, goodness, I mean, the stock is trading 42. It was trading 82 at the lows. You want me to buy it now when it's like $85? Right after the top of this B wave. Yeah, that's how you're actually supposed to be buying an ABC correction, right? Because until the top of this B wave gets taken out, then you have a weekly close above there, maybe even a couple of weekly closes above there. You have no way of knowing that this is indeed a completed structure, right? This could continue to fall. This could be some kind of an X wave, or basically, you're definitely having a lower high versus this high. But the moment you take that, that's when you are, you're having your confirmation of this being a very simple ABC. The moment you kind of climb above that level, this downtrend is pretty much done, and you're looking at the next sequence, and this could very well mean that the stock can go from 85 to 160, right? So you could still double, but you're not buying something that's still in a downtrend, with a lower high and a lower low. So that's the kind of the official way, the more correct way, if there is such a thing in markets, right? The more safe way, if I can call it that, of buying something. And then once that B wave gets taken out, then you can start to initiate positions, and then you add on the break of the top of this wave, because then you're looking for, and you're expecting a much larger move upward. Now, this is a weekly chart, right? So if you're going to make a new high here, of course, you can always fail. Anything can happen in the markets, but the expectation is that you're going to have a move that's probably at least the size of this move from roughly 27 to 92, right? That's going to start, back up here and continue to go. I mean, even if you take this move and you project it from the low of the C wave, there's still, a lot of money to be made after this top. So, that's kind of the safer way to kind of go about this. Now, if you don't want to wait that long and you say, well, how can I get into this thing a little bit sooner and still be, use this ABC to maybe build a position, right? And then I have a bit more. Well, this is where it comes in, and we introduce a moving average. And I'm going to put here a simple moving average, and I'm going to go with the 10-week. So that is basically your 50-day moving average, plotted on the charts, on the weekly charts, as a 10-week. So one way to do this is, and to work, because from Elliott Wave, and you're comfortable, and you say, man, this looks like an ABC, it's likely gonna probably work out. So how do I get into this? Well, first of all, you gotta wait until at least the prices get back above the 10-week moving average on this weekly basis, right? And the moment you get above there, you have your first chance to buy the stock, right? So if you can see this candle right there, right, that's when this close back here, it was right at the moving average, so that's a risky buy. But the next one over, it's the one that you can get into the stock, right? And then you're having your stops just below that week, Okay, you're not going all the way back here because it's going to be too large of a stop. But if you buy, right, and you're climbing above the 10-week moving average, right, you have a pretty small risk and you're looking for the upside. Now you can see in here what happened, and this is not going to work every time. This is the risk with buying things that are in downtrends, right? In this particular case, it worked for a while. But that's why you gotta get out of there if this happens, and then you look at the next opportunity as it climbs back eventually. So if you buy right there, right, and you have the stops above this week low, then that's your game plan, and then you can follow along the 10-week moving average, and between, let's say, I'm going to show you. Let me go back. Right, so I'm going to measure this, and you can see that from that weekly close, you can follow along maybe with the 20-day moving average and see how much you can squeeze with the stops below that 20-day moving average. And this, let's say all the way up there, can get you about a 22% gain, or maybe, even 20 or less than that. But if you're just saying that, okay, I'm going to follow the 10-week moving average, then you get out the moment you have a weekly close below that 10-week moving average, and that's right there where my cursor is, right? So that still gives you about an 11% gain on the stock while using the ABC as your backup, right? That's how, that's what you're basing your trading on this Elliott wave pattern, and that means that if this is true, then the stock should move higher. So now, you're getting out right there, right? And you have no business getting back into the stock because it closed below the 10-week moving average. And, it takes a while still until that sells lower, right? So now you're out of it. You're still watching it because it's still an ABC, but how are you going to get back in it? Well, you're looking at the next attempt, and the next attempt is right here. Okay. So it gets back above the 10-week moving average right there, right? That's pretty much the close at 55.35, and it never closes again back below that week moving average, 10-week moving average. So you go long again with stops right there. Now you got to watch money management and all of that, right? Or the weekly close. You can use both. And then let's say that you buy it right there. Right now you're looking again for the next weekly close below that moving average, and that's another, I don't have, let me see, right, let's say that you're getting in, I think it was right there, right, and you're getting out, I'm going to measure this out, like right there, right, that's about another 15% move. Right, so you're making, about a 10% here, another 15% right there, while continuing to use this ABC as a guide going forward. And in the meantime, the market is building, is making a higher high and a higher low. Now the next stage, it is back here, right? You're closing again above that 10-week moving average, and you continue to be in the stock, right? Because you get it right there, and now you're roughly 12% up. You can place a stop right below this low at about 69.50 or so, below the 10-week moving average, and you're continuing to go, and you're continuing to build that position. The moment you get above that B wave, right now you have more confirmation that this is the right stock to be in. Now you're getting above the fifth wave top, and you get more confirmation, and that's how you're building it all the while while using this 10-week, 50-day moving average as a guide for protecting yourself. And then you can start counting, from the lows and say, well, does this look like a leading diagonal in here? What is this? Am I going to do something like that and then drop lower? Sure, but what if you continue to drop? So you don't want to hold on to a stock that's breaking below the ski moving average, because you gotta have a line in the sand, right? Unless you're saying this is a very long-term investment and I don't care, I can hold it until, let's say 45 is my stop, and whatever happens between there and here, between up into this area, I'm willing to continue to kind of work with it. That's not my style, but it's something that you could consider. But again, it's about money management and how much leverage you have and all of that, right? So, but this is a very kind of simple way of doing that. Because this could be a very simple a wave one and a wave two, another one and a wave two. So you have a 1 2 1 2, and actually you're getting ready to break much higher into Schwab and continue to move, and that's kind of how you follow along. So I don't know if this it's probably, if it's helpful or not. Let me know in the comments. Check out all our daily updates and weekly updates on Substack. You can see that in the description below this video. We talk about this, and I analyze different stocks and obviously the markets. But this is one way to buy after you have an ABC correction, and there are ways to do it. When you have a WXY, maybe it's more complex, but this is the most simple and more basic form of correction, which is a very simple zigzag, right? We have triangles and flats and all that stuff, but looking at this very basic formation, that's kind of what it looks to be. And if I go let's say let me go to the other one here. If I go right here, you can see, let me go to a longer time frame. Maybe we go from 10 years to 25 years, right? So you can see this was another ABC right there, right? You have your 1 2 3 4 5. You have your ABC. I mean, look at the move that this made, right? So if you bought Schwab above this level, which is that B wave, and you added above that level, I mean, look, there were gains to be made right there. So again, if you look back here, right, this is another pretty straightforward ABC, right? So you can wait for a break of that B wave to start initiating positions. You have another one right here. So if you wait for a break of that level, right, you continue to go. So it's pretty. I mean, look back here, right? It's pretty straightforward. And it's kind of one way to to try to be in a stock and protect yourself. So thanks for watching. Don't forget to subscribe, like, and let me know in the comments what you think, and come visit us at Elliott Wave Cafe on Substack. I'll talk to you later. Bye bye.